Hi everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining me today is Irusha Peiris, who is a portfolio manager over at O'Neill Global Advisors. He's also an analyst at William O'Neill and Company, and he's also one of the nicest guys that you'll ever meet if you get to meet him in person. So, Irusha, thanks so much for being here and welcome.
Hey, great to be here, Richard. Thanks for having me.
Of course, and we're kind of on the other side of the table now. You
I
interviewed me
know.
on the IBD podcast, so it's fun. So, yeah, this is gonna be a really fun interview. Arusha prepared a really in-depth document with full of tons of examples of previous trades and lessons that he's learned. So we're going to get into that later on. But first, I always like to hear a little bit about people's backgrounds. So Arusha, would you mind kind of talking a little bit about how you first got interested in the markets and also kind of your journey up to this point and how you became a PM at O'Neill?
Sure. Well, I got interested in the markets back. I don't know if it was even really interested. I was just participating in the markets back in '99 when the markets were just going up every day. And so I had some money in the markets. I was probably a couple of years out of college at that time. And everything was working, so I thought it was a genius. It was really until 2000, and after that, where I rode the markets up in '99. I just rode them right back down in 2000, and so that's what kind of sparked my interest initially. Where I had heard and I was following all the kind of mainstream wisdom, buy and hold, and invest for long term and all this kind of stuff. Which, in many ways, that's absolutely right. But you need some kind of strategy. And so I just learned the hard way after writing everything down that the buy and hold strategy wasn't necessarily right for me.
Mm-hmm.
Luckily, during that time, I think it was probably '98 or so, I started thinking. I probably should learn a little bit more about the stock market. I didn't know anything about the stock market. I was a bio major. I didn't take any finance classes or econ classes or anything like that back then. But I happen to just remember a company named Investor Business Daily because on CNBC, and I wasn't really watching CNBC, but they would always have the commercials kind of running on. So I was like, oh, let me just take a free trial. And it was a computer readout. I didn't understand it. I never read it. But the one thing they did was they sent me a book. It was called The 24 Essential Lessons for Investment Success. It's a really quick read. And so I got that like in '98 or '99 when they sent that out, and to try to encourage you to keep sticking with the paper. But I didn't read it. But around like 2001, I remember I was like, oh yeah, I think I have like a book on stocks. And so I looked in my closet underneath everything, and there's this book, 24 Lessons. It was still in the mailer. I opened it up and I started reading it, and I had never heard anyone talk about the stock market the way Bill O'Neill talked about it.
Yeah.
And I read the whole thing right there. And I didn't really read that many books at that time. But that one I could not put down. I was like, it made sense. Everything he talked about really made sense. Look for growth stocks, have an exit strategy. That's what really kind of clicked to me. It's like, wow, yeah, there's a plan to the downside. There's sell rules.
Mm-hmm.
Never heard anyone talk about sell rules before. So that's when I really subscribed to the paper and just slowly read it. I still didn't understand the stock market that much, but over time, I just started to absorb things and started to understand a little bit better. And then in 2002, I went to a seminar taught by Bill O'Neill in New York. And it was really then, right before he got into the cab, I got the nerve to talk to him. And I told Bill that, it's my dream is to be a PM for you. And he said, keep working at it, write to me when you're ready. He signed my book. It was the second edition of How to Make Money in Stocks. I remember thinking after that, and he was the nicest person. And that was one reason why I liked him a lot. The seminar was just so unusual because he was talking about, you're going to make mistakes, learn from your mistakes. This is not easy. And it was like, once again, I never, ever heard anyone talk about the stock market like that, or really about anything. It's okay to make mistakes,
Right.
I was coming from school where, if you make a mistake, you get a bad grade,
Right.
right? And so understanding that mistakes are the key to learning, that was really, he really helped. He was one of the people who really helped, kind of make me realize that mistakes are okay. So that's kind of how I started the journey as a customer. I started during the 2001, 2002. All I did was learn how to sell very quickly because I didn't know what a bear market was. I didn't realize we were in a bear market, and so I tried some of these breakouts and I just cut my losses left and right.
Yeah.
But in the end, that turned out to become a very valuable lesson and a very valuable skill I developed. It was like 2.5 years before I even made money or progress in the market. And that was 2003 when the markets came around. And that was the time when all of a sudden everything worked like the book. And I bought on the follow-through day, I bought Amazon and Netflix and Yahoo. They were all like in the part of the number one industry group at that point, and they all started doing well. But then I made the mistakes of selling them too early, right, and watching them go up without me. And so it was this whole kind of process. But where it really kind of came together for me and started to make me realize that this is really worth continuing, it was 2008, where I was just following the rules like any other IBD reader, and we were all out of the markets well months before the markets really got bad.
Yeah.
And just by protect and so when it was the 2000 kind of bear market that inspired me to get into CANSLIM and IBD and learn the lessons from Bill. And then it was 2008 that kind of validated that stuff where I protect myself. And so then I took that money and I went to like all of the IBD advanced courses, the master's courses and stuff like that. So that's kind of how that journey started. And then 2009 or so, I saw an ad for Daily Graphs as a product coach there, and I didn't know what that was, but I was a Daily Graphs customer. I've been for years. It's like, well, you know what, the economy is bad and stuff like that, and I can this is my opportunity to actually try to follow something that I'm passionate about.
Right.
And so it didn't really matter what the job function was. I let me just get in there and see how it goes. And honestly, the way I look at it, that was the day I retired, because it hasn't felt like work for the last 12 years for me, because I'm working on something that I'm passionate about. And then after that, everything's kind of history at that point. But it started really kind of like everyone else, that you start at O'Neill, you start at the same level as everyone else, and then you just kind of work your way up and show your interest in the markets and stuff like that, and show some results, and eventually if you're lucky, they might give you an opportunity to manage some money in house.
Yeah.
So that's kind
Fantastic.
of the short story.
Yeah, perfect. And I see you've got a big bookshelf behind you over your right shoulder. So outside of that first book, what are some books that you think would be really helpful for beginners to pick up if they're really just starting to get into this, and want to learn more about CANSLIM or kind of CANSLIM adjacent type strategies?
Yeah. I always would recommend that 24 lessons book that I mentioned. There's another simple, easy to read Bill O'Neill book called The Successful Investor. He came out with that book after the 2000 market, bear market there. So that's another really quick read. So those are two books, and then of course the Minervini's books, Mark Minervini. He has a few books, but the first one, the first one is I'm drawing a blank on on these two books, but
Trade Like a Stock Market Wizard.
Trade Like
And
a
yeah.
Stock Market
Yeah.
Wizard, and then this, honestly, the second book, and I've told Mark this, the second book I think is like another level up,
Yeah.
uh, and because it goes into a lot of the stuff that kind of the subtle details of using a spreadsheet, letting the spreadsheet dictate your trades, and getting into kind of the nuances of really being so precise. And so that book is a huge book to read. Um, there are, I mean, obviously the kind of the classics, How to Make Money in Stocks.
Yeah.
How to Make $2 Million in the Markets, Nicholas Darvis. Reminiscences of a Stock Operator is I try to read that. Both of those books I try to read every year. So that's the Jesse Livermore book under the author Edwin Lefebvre. So those are the main ones that come to mind. There are tons of of others, but those are kind of the core books. What else? Am I missing anything there? I mean, those are kind of the
No,
classics.
those are classics. We can leave it there.
Okay.
Definitely, I'll have links down below. So if you didn't catch those titles, I'll have a link down below. And of course, you were the longtime host of Investing with IBD, the podcast. You got to interview some amazing traders: Mark Minervini, David Ryan, Mike Webster. I'd love to know if you had any kind of aha moments or picked up anything really special during any of your interviews with those type of traders.
Well, yeah. Well, Minervini, and I've been lucky enough to really get to know him pretty well. I don't think I've ever met anyone who's more disciplined than Mark in the stock market. So that it's not necessarily an aha moment. It's just watching him, just how he goes about things, and especially like at his event, it's great because he's it's non-negotiable. He really his volatility contraction pattern, the VCP pattern. He that's what he specialized at. That's all he trades, and then he just focuses on that, and he's become a true expert and master just at that. And it's a great example, I think, of you don't need to be a master at every different thing. You can really focus on one thing, and you're probably better off getting you'll make more results if you really focus on one aspect of trading. And I remember he told me one time that like years, this is back like in the 2000s or whatever, he would coach people and stuff like that, and he would say that for the first year he would just have them, they could only choose one pattern to focus on, and they could only trade that one pattern. And I thought that was one of the most brilliant things I heard. It's like, because you're going to really get to know the coupled handle really well, or the double bottom, or whatever pattern you choose, right? So that I think just how precise he is, how dedicated he is, and how focused he is. So that's always impressed me. With him, Jim Roppel, Jim Roppel's another good friend. He's always trying to going for the big wave, right? Find that major game changer. And he was coached by Bill for years and years and years. So he has a lot of those kind of lessons from Bill, and figure out the best stock in the market, get most of your, get a ton of money in it and hold on, right? Have that, develop the conviction to hold on to your winners, let them ride until they truly break the 50-day moving average, and really have that kind of those major sell signals. And he'll ride, once he gets up big cushions, he'll ride through some bases and stuff like that. So he's been a really good influence. David Ryan, I think David Ryan's probably the closest to the pure CANSLIM, because he worked with Bill back, in the 80s and stuff like that. And so he has those kind of qualities. And so it's always interesting to hear him. And I think everyone's watched IBD Live these days, or really lucky on Tuesdays, because you could hear David Ryan every week. So the way he talks about it a little bit different than everyone else, but right. It was last year he was talking about the commodities. Right. He said, he was telling all of us, he's like, you guys got to stop looking at the NASDAQ stocks. You got to start looking at these commodity stocks. And he was looking at them like really off, like so far off the lows. And I was like, David, how are you, why are these appealing to you? But he was just, highlighting that they went on these really big runs off the bottom, and now they're slowing down and putting these small bases, and he's buying like Intrepid Potash, and I can't remember the Mosaic, and a number of stocks he was getting a year ago on that, which is so impressive. So, and he has the patience to kind of hold. And if you ever watched the Mark Smith webinar that we've done a number of webinars with David, but the first one, I think, where he talked about Ollie's bargain outlet, and I think we all bought it at the same time. Like I bought it. I remember, I think Mark bought it. David bought it. Exact same on the same day. And you know, I sold it maybe I took like the 20% gain and stuff like that. And David, he sold half, but then he rode the other half and held like for a year plus and ended up getting this monster move out of it. So, but he did a lot of the research and really understood the fundamentals, and he had that conviction where I thought it was kind of a cool retail story, but I don't really have that understanding. So, yeah, those are three that come to mind. I mean, there are so many different guests, but I always try to get, I always like getting guests who were not necessarily focused on growth stocks and CANSLIM, because then that could help all of us kind of broaden our
Right.
horizon and kind of look at the markets differently, because we're looking at a little niche, right? We look at a very little niche, and that's fine. You can do well, and that's honestly what you want to do. But most of the markets are looking at a completely different way, right? They're looking at valuations. They're kind of spreading out and diversifying, and so it's good to kind of learn those concepts and the larger trends and stuff like that. So yeah, I mean, I've learned a lot from tons of guests, but those are a few
Yeah.
that come to mind.
Yeah, and all three of those, it's so cool to see how they've each specialized in their particular strategy. I mean, Jim Roppel and Mark Minervini are kind of as opposite as you can get. One's looking for the big move to ride a few stocks for hold them for a year or more. Mark Minervini's got that higher turnover rate, just looking to really swing trade and ride that momentum as long as it lasts. And obviously, both are fantastic. Have had amazing performance. So yeah, I think I've learned a ton from investing with IBD. I mean, I think it's a great resource. And just listening to their interviews, even though they have different styles, the principles that they abide by are very similar when it comes to risk management, routines, that type of thing. So yeah, I love talking with traders who have more experience than me. I can learn so much from them. And yeah, those three, David, Jim, and Mark are excellent to learn from. Yeah, and just so people are aware, because I think it's good to understand kind of a guest time frame. Could you talk a little bit about your particular style? What do you look for, and also what's kind of your average holding period, average loss, average gain, if you have those statistics?
Yeah. Well, so really depends on the market,
Hmm.
right, or the environment we're in. If we're in a strong trending environment, a lot of times I'll just naturally kind of gravitate more towards the most powerful breakouts, earnings gaps, and I'll show some kind of examples and things like that. But just really powerful moves that are emerging out of consolidations.
Yeah.
When you're in a choppier, trendless type of environment, I'll try to buy within the bases and off support and things like that. I am not nearly as good at buying within the bases and off support. I learned kind of the traditional CANSLIM way years ago, and for whatever reason, it's just that's kind of just imprinted in my brain, and it's really hard to change and adapt and be flexible. So, which I've been working on to try to add more and more things to the repertoire. But the one that the kind of the classic kind of strategies that I'll use are more kind of just the powerful breakouts
Hmm.
and uh, yeah, I mean just those really strong breakouts, especially after an earnings event and things like that.
Perfect. And pretty much my favorite question to ask people is about their both weekly and daily routines, because I think that kind of gives people insight into what it takes to treat this as a business, as a professional. So maybe we could start with kind of your weekly routine. Could you kind of break down what you do to look at the market, look for setups, and kind of build that universe list, the focus list that you're going to look to potentially trade that next week?
Yeah, it I do most of my work on the weekends.
Yeah.
So that was a revelation to me when I started out. You know, it was just kind of like every day I'd kind of pick up the paper and kind of see what's there. But what I noticed, and that's how, you know, kind of how you learn. But what I noticed, I was always kind of missing the breakouts. I was always late to them. I do most of the work on the weekends. The easiest way to start off with, and you know, because this was developed in house to help us kind of do this, is the Growth 250 from Market Smith.
Hmm.
Essentially, what that is it's 30 different screens. Mike Webster created it, and it's just creating a universe of stocks that that have potential. They're not all going to be perfect setups at that point, but the goal of it is to just get you familiar with the stocks. So you're going to see a lot of stocks in a list like that that are extended, uh, and they've already gone on their big runs, but you at least you're starting to see the names. So you're a lot of times I'm just hitting the space bar pretty quickly through them because they're extended, and my eyes are more focused on what's setting up at that point, right?
Mm-hmm.
Which ones will give me a chance over the next few weeks to get into, but seeing those names though, it'll help just start building that familiarity that in a couple of months, those stocks that went on those big runs, they might be starting to build the bases, right?
Right.
So that just helps me at least slow down and say, wait a minute, I've seen this name a number of times. I don't know what they do. What do they do? Let me do some research on it. So just going through a number of names of potential every week, and this on the weekend, it's usually like a Saturday. I'll do it just to knock it out of the way. That helps build the familiarity. So I'll go in the simple kind of ways, grow 250, 300 stocks, narrow it down. And now this also, and this tells me about the market too.
Right.
If I'm writing down a lot of names that are setting up and we're in a correction, what that's telling me is that we might be getting close. The indexes might not necessarily be showing it because maybe we're in a correction and maybe we're still going down. But underneath the surface, there are a number of growth stocks that are saying they're ready to go. They're getting set up. They're ready to go. They're building the right-hand sides of bases. Maybe a number are putting handles. They just want the market to come around. And one of the key kind of ways that I saw this, and this is actually when we were developing the prototype of Growth 250. And so Mike Webster and Scott O'Neill were working on the Growth 250, kind of the logic and stuff like that. I was going through the results. Like we'd print out these books and just kind of go through the results of them and stuff like that. And I remember it was March of 2010, going through, and that we were I guess it was in February. We were in a correction at that point, and there were a number of bases starting to form, and there were like 10 stocks that started to appear, and they were all in the restaurants group,
Mm-hmm.
and it was the restaurants group at that point was 50. And I remember just things like, wow, here's another one. Here's like, Starbucks is in the restaurant group at that time, but I think it still is. But, or Domino's Pizza, and then Chipotle was appearing, and all these stocks. And they're starting to form these bases. We're in a correction. And then I think it was like March 1st of 2010, we got the fall through day. And then you saw one after another, these restaurant groups break out. And they were still in the 50s, but that rally started to move. And I think it might have been like a 6-week rally, but that restaurant group that had this nice concentration of stocks within the Growth 250, it was this nice concentration of restaurant stocks. It went all the way up to number one. It went from 50. It was like almost seeing the future. I could not believe it. And what was the best stock in the group? Chipotle.
Yeah.
And that was the beginning of Chipotle's monster run back then. It's not the classic one that we show in September of 2010, which was coming out of a beautiful, perfect cup with handle. It was before that. It was the initial kind of run, but there was another not as perfect cup with handle there that I think Bill was buying. I know Bill was buying the one in September of 2010, I heard, but I remember because I tried the one in March. I think out of the 3-week site, I was a little late, but it was just really cool just to see how you can kind of get ahead of the game when everything lines up. It doesn't always work that way, but so do most of the work on the weekend, come up with a number of stocks that are building bases. You can set alerts these days. It's pretty easy to go through, set alerts on it. And that way you don't have to do that much work on the weekends. You're just kind of monitoring your game plan. So the way I always describe it is create the game plan on the weekend, monitor it. So
right.
I'll spend the weekends to kind of do all my thoughts, and then I kind of have it there during the weekdays. And so that way you don't have to worry about doing all this work, because
Yeah.
it's much harder to do it during the weekdays when the markets are live, and and then after the markets you don't always want to do the work and stuff like that. So especially for people who are not doing this full time, they're doing this on the side. Doing the work on the weekends was definitely the biggest thing. So that's kind of the gist of it.
Hmm.
Now, eventually, and I generally tell people, in the beginning, if this 300 is too much, just go through 50, right? Go through the first 50 and the growth through 50, go through the IBD 50, go through another big cap 50 stock, something like that. But just get in that habit. Eventually, what's going to happen is you'll become efficient that you can go through 1,000 stocks in a pretty quick amount of time, and still pick out the ones that are setting up and stuff like that. But the more the list kind of grows, that's telling you that the market's getting ready, it's getting stronger. And then when the list shrinks, that's telling you that maybe we're getting too extended. Maybe the market's really bad. Maybe we keep hitting real lows on both the markets and underlying stocks. So that it not only is it help me prepare for the markets, but it just gives me a feel for the market. So that's that's kind of, I guess, a simplified way of how I do the routine.
Yeah, fantastic. And kind of on the flip side, like just like how when we're in a correction, the indexes might not show it, but stocks are setting up. When you see those leaders start to break down ahead of the index, that gives you a warning sign as well. That's very important information to keep track of.
Yeah, I mean, the way I've always described it is the market will slowly pull you in and slowly push you out.
Yeah,
And so you were describing the pushing out part
yeah,
and that was kind of like in November, what we saw last November, where a lot of these growth stocks were going through the roof and running. And that it's, things are getting a little too crazy, but you're still trying to hold on at least some of the stocks. But then all of a sudden they start breaking, I think end of November, a number of them are breaking, so the market's slowly pushing out. But then some of the larger stocks are still hanging in there, so you'll hang on to them. But what I've found is if you're truly listening to the market, especially when the markets are working well, and you're selling when you're supposed to sell, or when they're breaking key averages and stuff like that, uh, you'll probably be like 50% cash before like IBD puts the market into a correction,
hmm,
because the fastest ones are going to break really hard, and you're just going to naturally be forced out of them.
perfect. Well, Arusha, let's jump into more of your strategy and bring up some charts. And I'm also looking forward to hearing about these lessons that you've learned throughout your career. So let's open that up.
Yeah, so let me just pull up the. Here we go. Okay, do you see
Yep,
full
perfect.
screen? Okay.
Yeah, full
Well,
screen,
yeah.
perfect.
One of the goals that Richard and I were talking about in our prep call a few weeks ago was, so Richard, you have a lot of people who are younger, getting started a little bit more and stuff like that. So I kind of wanted to share some of those lessons that I've learned that hopefully others will learn better than I have. Uh, but I also wanted to share a little bit nuances too,
Right.
different kinds of ways that I look at the market, or just different entries and exits. But so I mean, really the key thing, and everyone's heard this, but if you're newer, you have to get this down. You really have to get the defense managing, cutting your losses quickly, managing your risk. You have to get that down, or don't bother trying trying to do what we do, right? Just go and buy the S&P 500, put it in an index fund, and just ride the markets up and down. That's totally fine. There's nothing wrong with it. Most people do that. But if you're going to start trying to get in some of these faster moving stocks, that some of them, are really go all over Twitter and stuff like that. Uh, a lot of these stocks, they are dynamite. They will go up fast. They will come down a lot faster, as
Yeah.
we've seen over the last few months, with a lot of these higher valuation type of stocks that were rocket ships, but they all came crashing down. So the first thing you have to do, play defense. You gotta defense wins championships. You got to get that done. And so I'll share kind of how I learned. I learned this the hard way. How I learned to cut losses. And here's one. This is just one example. It took me probably 4 or 5 of these to finally, sink in my head that, oh, this is why you have cutting losses, right? So Skechers was one of the first stocks I ever bought. This is in 2001. And so I bought it around. I bought it around here. A little extended and all that stuff. We're all going to do that, right? We're all going to make those mistakes. We're not going to be precise in the beginning. So I bought it here, and now I'm up 20%. Now, in Bill O'Neill in his book How to Make Money in Stocks has a rule: when you're up 20%, you should be taking some profits and not all of them. I didn't do that with Skechers because there was a Skechers right down the street from me. I was going and taking a look at the stores or people going into it as a newer product. I had conviction, I said I'm going to hold this. So I didn't. I was like, why would you ever sell at 20%? This thing's going to go much higher. So I didn't sell there. Now I'm down 8%. So I've lost all that 20% gains. Now I'm losing money on this. I'm not going to sell there. I'll just wait and sell it at 10 when it's back up at 20%. Right? I'll sell it then. And I just kept holding on, and I finally sold around here. So I probably lost like 60, 70% at that time. Now, the reason I'm still here is because I was playing very, very small. Okay. So I was blowing up my account with playing very small because at least initially I knew that I don't know nothing about stocks. Right. And so I'm going to play really small because I'm pretty risk averse in many ways, which is why what Bill was talking about really appealed to me. I really wanted these exit strategies. So this was one. There are a number of others that I just wrote down, and some I even held for 15 years to see if I would make the money back, and I never did. Right? I just wanted to see, and I just always kept it as a reminder initially to cut my losses, and I was on like 70% on some of these stocks. So now I'll talk about some of the lessons that or kind of the strategies, because I'm just kind of a classic kind of breakout person. That's how I learned, as I mentioned. But over the years, the market's always changed. They're not always going to be nice trending markets, and so you're forced to try to do things if you want to improve and try to get a little bit more of an edge. And breakouts are just obviously, I think, as a lot of us know, that sometimes it's become too obvious. That it's Bill O'Neill did too good a job, I think, in many ways. He shared the knowledge too much, and it spread too far. And so breakouts also are kind of the target for people to sell into. Now, when you're in a really strong market, breakouts are going to work really well. Like 2020, people are trying to short those things. We're getting run over. But we're not always in strong trending markets. And 2020 was a very, very unusual year. But so here are some examples of buying within a base. So NVIDIA, and this was in last year in April, so almost a year ago. So you can see it's forming a cup, and NVIDIA went on this really big run and took like a good 6 months off. And so as it was coming around here, so I was just buying out here, and not a huge amount, but just to start scaling into the stock, right? One thing I liked, it undercut this key support area, right? So you're shaking out all these people. So shakeouts are really, really important too, and that's something that took me a number of years to learn. But so as it's coming up here, I'm buying a little bit here. Yeah, and now the market wasn't, this is when the market was really rewarding the S&P 500 stocks, commodity stocks, and so a lot of the NASDAQ stocks were not doing well. But whenever a Tesla or an NVIDIA, whenever those type of stocks try to go, I try to get into them at least somewhat. And so NVIDIA came here, it probably lightened up a little bit, and might even gotten shaken out here as it was just coming in, and NASDAQ stocks were just not necessarily in favor at that point. Now it forms again. Here's your classic kind of breakout. So you had an opportunity right here to buy in again, add to it as coming out of this base, and now you're starting to get going. So when stocks break out, this is what we expect, right? When everything lines up. And so this was around June, and a number of NASDAQ stocks around that time, they actually did start going working well and started trending well. And so you finally get like a really nice uptrend. You're starting to get away from this 200-day moving average, forming another cup with a handle. It gives you a chance. I mean, either you can lock in some of your profits here because you're probably up 20+%. I think this was earnings right here. And then it gives you an opportunity again to start building that position. And then you have a little bit of shakeout and you're coming back up through the 50s. So that's, again, another place where I tried it. And so this was in October of 2021. And that's when, kind of had that last hurrah where all of a sudden now the Nasdaq stocks were trying to catch up with everything. And this is where I started getting out of it. Now, selling into strength has been always one of the hardest things for me, because finally, after, here I probably tried NVIDIA. I tried NVIDIA a couple of times here too. You're getting whipped around all the time, right? Now, when you're here and you buy it and you're up like 40, 50% on the stock, you're finally right. The last thing you want to do is sell it, right? It's like, wait a minute, it could go up to 100%, right? This is NVIDIA. They're changing everything. Everyone needs their chips, right? It's very easy to talk yourself into this. And I would always do that. I would buy these things and just ride them right back down, buy them, ride them back down. So our stocks, unless you're in a very, very strong market, our stocks, they go up fast, they come down faster. And so here I actually did sell out of it, even though it was only 13 days after breaking out. So after the last base. And so it was very hard for me to sell out of it, but I did. I said, let me just lock in this game here. Now, of course, I couldn't stay away from it. I had to get back in it once it was going up higher again. So I didn't buy nearly as big a position as I bought out of the base here, but I had to get some of it back. That's kind of the mental health buy that David Ryan will talk about and stuff like that. But I was reminded, once again, so it failed very quickly. So I got out of it. But, this is where we are within NVIDIA right now.
Yeah.
Richard, jump in at any time here, but to ask questions, stuff like that. But
yeah, I was wondering if you could kind of quantify the setup you look for up the right side of a base. What are you looking for in terms of price action, the moving averages shaping up? What's the overall setup that you're looking to use there?
Yeah, so if I go back, I'll go back to right here, right? So you don't always have to have the big volume coming into it as it comes up through the base, but especially when it's coming through the 50, a lot of times I like it to go through just kind of a little bit of a resistance. Right now, the 50-day itself is resistance too. So, but you have two reasons for entry right here, because it came up to the 50, hit it a little bit, came back down. Look at the volume. The volume is tiny right here, right? And now it kind of shoots back up through. So yeah, it was coming. So a lot of times, even if it comes through the 50, that's, as long as it's not too V-shaped, that's, good enough reason for me. But if it has a little bit of on a price level, a shorter resistance there, a short-term resistance, that's another thing. But I don't always require the volume. One thing, like a lot of people always look for, and I would always look for this too. The one place where I'm going to require the volume, and not everyone requires this, but I will, especially for kind of the larger stocks. I will require volume at the breakout, some really big volume. Like I want a powerful breakout. And that's the reason why I do that, is because those, over the years, I found out those are the stocks that worked for me, right? There are plenty of others who they don't require it. If it's crossing, they're just going to buy it. But for me, when they had this monster volume coming into it and it's breaking out, and it's finishing at the top of the range, and also it's a technology, large cap type of technology stock. Those are a lot of those characteristics for me that I have done best at over the years. So if it fits that, it's like no hesitation for me. I'm going after that because I, just based on my history. So one thing that, especially for those who are newer, the way I look at it is, especially with what the concepts of what they talk about, how to make money in stocks book, what Mark Minervini talks about, what all the growth investors talk about. You learn those concepts, but there comes a point where you have to adapt those concepts to your own personality.
Right.
And so this is how I've adapted it. I work in house with a lot of others who've been trading and studying CANSLIM, studying the O'Neill strategy for 20, 30, 40, 50 years. We all trade differently. We're all in different stocks, but we're all using the system. It's crazy. You would think that we'd all be buying NVIDIAs. And a lot of times we will all be in the same stocks. But when you look at our portfolios, the overlap might be like 50%. Sometimes it's less than that because some are just really good at small caps, some are good at large cap, others are good at IPOs or buying pullbacks, stuff like that. So it's really interesting. But the way I've gotten better at this is when I finally kind of took those concepts and adapted it to myself, because now I could make the decisions for myself. I could learn, make those mistakes for myself and learn from those mistakes and slowly keep adapting it towards my own personality.
Perfect. And can I shoot you some more questions
Yeah,
about this
go
NVIDIA
for it.
buy? Perfect. So I kind of want to dive deep into the logistics of buying a stock up the right side, and like you're trying to do. And so first things first, imagine it's the weekend or it's the day prior to this move. What are you looking for in terms of how it's setting up with price action, moving averages? Where are you setting an alert line to potentially get you interested in looking at the chart intraday? And also on that day where you're looking to buy through the 50-day, which is the setup on the daily, are you looking at a different time frame to kind of, move in a little bit earlier to judge accumulation, to judge volume, judge price action? What's kind of going through your mind, and what's kind of your process for actually buying the stock on that day?
Yeah. So, well, for the alerts, I usually set a few before, kind of getting above the 50-day, and also right around kind of there is some resistance right around there and a
Mm-hmm.
little bit above. So I'll have a number. I kind of stagger the alerts. The reality is that especially when we were all working the office and stuff like that, I didn't have time to watch the markets all the time. So I just set tons of alerts. So just keep alerting me and
Yeah.
reminding me because I'd miss it. They just get buried in emails. So I think you have to adapt that also to if you're just focused on trading and you're just watching the monitor all day long and watching the quotes all day long, then you have a little bit more flexibility, and maybe you only have to set one alert. But for me, I have to set tons of alerts for something like an NVIDIA
Yeah.
that I have a lot of conviction in. So that's the first thing. Honestly, with the moving averages when they're coming up through the 50, I'm not necessarily paying too much attention at that point to it.
Mm-hmm.
I mean, the key moving average is the 50-day moving average. One because a lot of times when they're basing like this, you're going to have
They'll
the
chop
shorter
around.
term moving averages below. They'll kind of go above and below. Once they
Mm-hmm.
start trending, then I want the 10 above the 21 above the 50. And so when they trend like this is telling me that this is it's in a pretty strong trend. And when everything lines up with the market and the stocks that you're looking at, especially these growth stocks right here, you'll see where the best ones will be able to stay above the 10-day probably like 4 to 6 weeks. Then they'll break the 10-day and maybe catch the 21-day for a little bit, and then they'll break the 50-day, eventually break the 50-day. So that's kind of how I'll use moving averages. I'll use them more as
Mm-hmm.
a guide. Recently what I've tried to do is and I'll show an example of this, but using the 21-day sometimes to buy on a pullback that's up from a really strong stock that's trending really well. But yeah, I'm not necessarily using the moving averages at that point. Besides the 50-day, I'm going to use the price action. I don't require a huge volume at that point, so it's more kind of I'm just sending those alerts for those key ones that I'm looking for. Um, and yeah, I keep it pretty simple like that on that. And it's not like I'm trying to buy through the 50-day for every stock,
Right.
right? There are, I mean, the first kind of screening process that we'll do, that I'll do, and then the growth through 50 will naturally do this, or any other kind of O'Neill's type of screens. You're screening first for kind of some kind of fundamentals or some kind of story theme that's going on. And then a lot of times I'm actually going to look more towards the larger type of stocks, the more liquid type of stocks, because I've just done better on those type of things. After that, now you have a smaller list, and like a game changing stock like an NVIDIA, those are easy, where it's just like I don't want to miss them, right? So
Yeah.
it's like if it goes through the 50, let me get some of it, and it's not necessarily a huge purchase on
Mm-hmm.
coming up through the 50. It might be like a 5% position. Let's get a 5% position in there. As it moves up a little bit more, let's slowly build up. If I'm up like 2%, add a little bit more, and slowly add up a little on it. So after kind of that 5% where that might be a little bit more precise, the other stuff is a little bit more art. And you'll probably hear, I'm sure you've heard it, but others, you'll hear it from others. There's a lot more art than science here. When I learned it initially, it seemed very, very black and white. But as you learn this more and more, and really get into the nuances and details, you realize that there's a lot more gray than black and white, and that's where you're adapting it to your own personality. But here, kind of the one precise thing is, as it's coming through, let's just get some.
Yeah.
It might work, it might not. There's only so much at that point. But I'm not doing this for every stock. It's just for those key stocks, even kind of earnings gaps. Where I'll show those examples a little bit later. I'm only taking these type of risks for stocks that I think are game-changing stocks. I think that's the key. It's worth it for me to take those risks. It's not like any stock that kind of technically looks well. If in that case, then it's probably there. I'm not going to be doing these kind of coming up through the 50s and stuff like that.
Gotcha. Yeah, perfect.
Did I cover those questions? Or?
Yeah, I think so. And a follow-up for that is, since you're kind of building a 5% position, for just for an example, it might not be always 5%, and kind of using this spot right here up the right side as an example, this is where it first came through the 50-day here. And then this kind of acts textbook, because we get that push up, then we get really tight, we get a secondary buy point. Are you looking to kind of add on through that secondary buy point? Absolutely. As it kind of confirms, and you just kind of build your position before ideally the true breakout? So yeah, is that kind of how you try to handle it?
Yeah, and then I'll even buy on the breakout too.
Yeah.
Right. So for and this goes back for those handful of stocks that I think are game changing stocks, right?
Yeah.
Where I'm just going to keep buying up, and this is like where, it's much more subtle, and it's not kind of the clear type of super strong breakouts and stuff like that. So because I don't know where in this group was ranked at that point, but the semis were not doing that great at that point. But once you got around like June, you had that brief kind of move where a lot of kind of those classic tech stocks had like a good month or 6 weeks.
Yeah, perfect. And I'm sure a lot of people, especially newer traders, I get this question a lot. They're always wondering where they should put their stop loss, because this isn't a classic breakout of an early stage base, use that 8%. And a lot of people I've interviewed, they like to keep it a lot tighter than 8%. So I was wondering on a buy like this, or like we call this kind of a consolidation pivot up the right hand side, where it's not a true pivot, but it's kind of formed a little bit of something, just this high right here. Where do you usually like to keep your stop loss on that first buy? And how would you move it up as the stock makes progress?
Yeah, so for this first one, a lot of times when I'm coming up through the 50 or even buying on a pullback to the 50, it's usually 3 to 4% below the 50. I'll try to keep it. Now one thing here is, the one thing you have to be a little bit careful if there's a little bit of a gap here, and these gaps can fill pretty quickly. So you can do a visual thing. You can do a percentage thing like 3 or 4%. You could also do using visually looking at the price action, maybe keep something like that. I keep them pretty tight around there. And you're right, with the breakouts, on average, my average loss is probably around 5%, 6%, maybe not even 6%. It's probably around 5%. Because I'm a lot of times, especially once it gets out and starts breaking out. So like, for instance, like here, right? So scaling in here, now I'm in, now it starts coming back in. Once I'm getting back into the previous base, a lot of times I'll sell in third. So I'll sell a third when I'm down 3% on the position. Sell another third down 5%. And sell the last remaining at down 7-8%. So I like to scale in, scale out. That was another big revelation for me years ago. It's like kind of taken for granted these days, but I was always all or none. It's like, everything in, everything out, right? And it's, the markets are too fluid, and so I just learned over the years just to slowly scale in, slowly scale out. That enabled me to kind of stick with some of these moves a little bit longer.
Yeah, 100%. And sorry to keep focused on this chart, but NVIDIA is such a great example for so many things. So say you've got a position and it's working for you. What ultimately kind of kicks you out of a stock like this? when you've got a nice trend, what would make you sell that last position? And do you like to hold some through a base and try to play for that longer move, at least a portion? How do you kind of handle that? Because I think sell rules, especially for beginners, it's the hardest thing, and it's probably something everybody works on for their entirety of their trading career. So yeah, I'd love to hear your thoughts on that.
Yeah, it's a nonstop type of kind of. Every time I feel like I've come up with some rules that will work for me, a new market will come around and kind of throw me off kilter.
Yeah,
Or you just let you become human and just throw things left and right after, because when the markets are doing bad or you're doing poorly. I'm the hard thing that's always been where it's been hard to communicate to people, and you kind of have to just learn this the hard way, is we're just looking at NVIDIA. You might have 5 or 6 stocks, 10 stocks in your portfolio, and they can all be coming down at the same time.
yeah,
When the markets are bad, it's amazing at how, or at least my stocks, they all just come down, and so it's not just NVIDIA that's coming down at that one time. So from then, at that point, you're forced to line up. Either once you're either cutting from the bottom where you're looking at performance, and one's clearly hitting 8% and you're down 8%, those are easy to cut. Or others, if they're all kind of coming down, they're all kind of the same, then you kind of I'll kind of just do, okay, lighten up on every position, right?
gotcha.
I need to raise cash because everything's coming in. I'm out of sync with the market. I'm not making any progress, all that kind of stuff. So we're looking in a vacuum right here, but it is amazing when if it's one stock like NVIDIA, if NVIDIA is falling down like this, you can guarantee all these other stocks are coming in at that
Yeah,
point too, and it really sucks. So even though it's like, oh, I didn't break the 50-day and all this kind of stuff, let me hold through it. It's harder for me to do that. A lot of times I'm going to lighten up and probably throw out all the positions and then try to hold, or cut the weaker ones and try to hold the very strong ones. But holding the base part, I'm not very good at. I'm terrible at holding through bases. It just wears me out. So a lot of times I'm pretty quick to cut and run, which is why I've tried to start to focus being more proactive at taking gains when they're up. So a lot of times what I'll do, it really depends on how strong the market is. If a stock's able to trend and stay above the 10-day for a couple of months, right? So I don't have anything precise here, and then it breaks the 10-day, right, on one of these days right here, I'll sell like 30% of it, of my position. uh, and then now I might scale out a little bit more on if it closes below the 21 day, that's not necessarily good, so I'll sell a little bit more there, and then I'll try to hold. And I'm trying to sell proactively to try to get it to a position that I can hold through until it breaks the 50-day.
hmm
And that doesn't always work. I mean, there are times where it's just like, because you get so much back that it is it's awful. I mean, it
yeah,
really affects me. So it's like, oh my God, I was up this much, now I'm getting this much back. And so you're trying to hold on to those kind of key positions. But I think probably the closest thing to kind of having the rules, because I wrote out all these rules, like when I sell, when it breaks the 10-day moving average, if it's trending for a couple of months, if it breaks a 10-day, I'll sell 25% of the position. If it breaks the 21-day, sell another 25%, and now I'll hold the last 50% at the 50 until that breaks. Which it's a good rule. It works. It's sometimes just hard for me to personally do it. It's in real time, where I just the way the markets come in, my state. Sometimes it's just like I'm lightening up because I'm looking at how much I've given back from the
yeah,
top, and I want to try to have enough of a cushion on a portfolio side to get more kind of the rebound. Now there are plenty of times where I sell too much and it rebounds, and I'm like, oh no, now I'm out of position. So those are things that I still have to work at, and so this is part of the never-ending process where you're just kind of constantly analyzing and what rules can I write to do that. So a lot of times I try to have 3 key positions. These are my kind of main positions that I don't want to sell as much of. Everything else I can throw out pretty quickly if things start getting bad. But Yeah, those are some of the rules right there. So for instance, in this kind of case right here, if you bought out of the breakout here, when that, you could have down here, you'd have your 50% of the position you bought here. Now here, see, this is where the problem is. I'd probably be cutting out everything at this point, right? So you cut out everything, now you start building the position again. And that's honestly fine. But you'll get different answers from this. Where if you have for an NVIDIA where it is one of the higher conviction stocks, there are times where I've done it where my cost basis is down here, so you can cut it down to the shares that you bought here, right? And so even if it's breaking the 50 here, I'll try to give it a little bit more. I might lighten up, but I'll try not to get completely out of it, hoping that it does something like this. Then you can buy. So it just really depends on what stock is doing it. But there are plenty of stocks where once it breaks that, I'm out. I don't care, and I'll get back into it here. So
Yeah. Yeah, that makes a lot of sense.
Okay.
I think you expressed a lot of the feelings that a lot of traders have when everything is coming in at once. You feel that pressure in your overall portfolio. You don't want to give all of it back. No, I think that was great. And I wanted to ask you if you've kind of tried to implement any kind of extension rules. So selling progressively when a stock gets, I don't know, 20% above the 20-day or a certain amount above the 50-day moving average. I wondered if you looked into that at all to kind of, take a little bit off when it's a little bit historically extended, then maybe look to buy it back lower on a pullback type buy, kind of trade around that core.
I've tried to. I haven't gotten it down to a thing, kind of a set of rules that help me because every stock it'll be different kind of extensions from the 10-day and the 21-day. So I'll kind of look at it visually, and this also it still comes down to the kind of the conviction in the stock. There are times where I don't necessarily want to lose an NVIDIA, so I'm not going to play around with it as much. But for some other really high flying stocks that don't have as much conviction or maybe doesn't have the huge earnings and sales and all that kind of stuff, then that's fine. I'll look at it when it gets ridiculously extended from the 10-day. I won't necessarily have a percentage, but I'll kind of look at it visually and kind of compare it to, I mean, look at this one right here, right? I mean, over here, it's like once they go kind of vertical like this. And actually I was in this, so I had, I think I had maybe a 20% position. I did not have as much, but I had bigger positions in other stocks. But once it went like here, I was selling into because it's just going vertical. I mean, here it doesn't look that big a deal. Go back in September, early September 2020, it was just stupid. It's just like vertical like that. And so that I remember because my whole portfolio was just through the roof at that time. And so once again, it's like I don't want to sell it because it was just amazing. And what if it goes up again the next day? But I have to sell some. And even then, looking back, I didn't sell enough, because look how hard it came in. This was not just NVIDIA. It's like every stock. Came like that. Like DocuSign came in really hard. All the Zoom came in. All those stocks back in the day, they all did the exact same thing. And those are pretty big givebacks.
Perfect. Yeah, we've covered a lot on this NVIDIA chart, but let's push on because I'm looking forward to getting into the earnings gaps because I know that's something you've really looked into and researched.
Yeah. So let me just jump here. Okay. Yeah. So here's AMD around the same time as NVIDIA in that end of last year. So right around here, so you can see it is from that double bottom. So so there are a couple of rules. You have the nice shakeout here, right? So you're undercutting that 101 level. You're coming back up. So there are a couple of things here you could use. You could use the shakeout plus 3. Usually I'll use 10%. So if you add $10 to this, you're essentially at 110. So you could use a little more shakeout plus 3 rule as a reason. Or you can use, it's getting back above this 108 level. Now, the cool thing about these little short-term highs and lows, you can actually use those. I like to use those sometimes as resistance areas because the way those are printed on the chart, I think it's 8 or 9 days. I think it's 8 days. So it's the 8-day high on both sides, right? So 8-day high or 8-day low. So this day right here was higher than any of the 8 days previously. before and after. So if you see one of those prints and it's building a base and it's getting through that, that's almost like 20 days. That's almost like a 20-day high. I think that the turtle traders like using that stuff back in the day. So those all kind of line up there. So it's a decent amount of time just going sideways here, and it's emerging out of that. So there are a few things here. So you have the undercut, Livermore shake-up +3, the short-term high coming up through the 50. I don't like that. You have that little gap here, which could happen. Volumes increasing right here.
Yeah.
Right. So all these things were kind of lining up here. The relative strength line is starting to come up here pretty good before. Look how low the volume is. So the selling has kind of, everyone who wanted to sell has sold during this time. So now this whole part has been just a wearing out process. So this was a place where I was buying AMD at this time. Now AMD really annoyed me because I missed out on this part right here, and this is all psychological stuff. I was trying AMD and all this time here getting whipped around, especially around here, and never making progress. So once it finally set up again here, I was like, "Oh, you're not going to fool me this time, AMD." And then boom, right? So you have to kind of have an open mind and kind of erase your past feelings about the stock. If they've shaken you out 3 or 4 times, there's an odds are the next one's going to work, because you're not the only one who's gotten shaken out. But so this one does irritate me because I did miss out on this, and AMD likes to do that. Goes sideways for a while and then pop.
Yeah.
And so I had that pop right there. So those were kind of the things that I was looking at here. Now the mistake is I sold out around here. It was like a 20% gain, and this is the one I had both NVIDIA and AMD. So let me just lock in the gains here, which necessarily wasn't a terrible thing initially, but where I made the mistake was, it came back to the 10-day, and then you had this big surge right here, and I did not get back into it. It came back to the top of kind of previous resistance, back to this 10-day moving average, undercut, and then had a surge. I should have bought back into it. So that's looking back, even in real time, I was killing myself over it. And notice, or you can keep a simple rule like, for some of these large stocks, just use the 10-day, right? Look, it would have kept you in this whole time, right? So sometimes when these stocks work, and you can't imagine how far they can go and how far they can stay above the 10-day, especially these larger stocks that you think that how much further can move. There's just so much money out there that can move these stocks. So that was NVIDIA. Let me go through. Sea changes sentiment. So this is essentially, with the sea changes sentiment. So this is something that Scott O'Neill back in the day when we were all at MarketSmith, and Scott was the president. He would talk to us. We were really lucky. He would talk to us all the time. We kind of have these little market huddle sessions. And come out and talk to us like for an hour about the markets and stuff like that. And so one thing you always emphasized was, is there a sea change of sentiment? Is there a character change in the stock? Pay attention to that, right? Boats don't have brakes. Once that momentum goes for some of these stocks, they can keep going. Strength begets strength. So you would come out and kind of tell this to us all the time, and it really did sink into us. So we're really lucky about that. But so one thing that with this kind of sea changes sentiment, that's kind of the thing with the earnings gaps that for me it kind of gravitated towards, and where those kind of just stuck out to me a little bit more. For every person, a certain kind of setup, a certain kind of characteristic of a stock, it's just going to stick out to you more than others. For some, it's the pullbacks. Others, it's undercuts, shakeouts, stuff like that. Others are just kind of the classic base patterns. For me, it was just always these kind of earnings gaps. Every time I looked at like some of these stocks that ended up going on these really big moves, a lot of these were game-changing stocks, and they just had around the beginning of their runs these kind of strong earnings gaps. And so I kind of would focus on that. I wouldn't necessarily always buy them on those days, or I'd buy a small amount. And I wouldn't use this. It was kind of like coming up through the 50, but even less for these kind of earnings gaps. If I would buy on that earnings reaction, it it's only for a handful of stocks because it's a very easy way to get killed on these things too. But I'll go over how I kind of learned the hard way about these earnings gaps, and I'll just go over some of these kind of classic examples. But uh, this is how I learned the hard way with the earnings gap. Here's Google. This is 2005, and I remember when Google came public, and I didn't. No one told me about these IPO bases back then. They never weren't talking about IPO bases back then, you know. So I didn't know about this at that time, but we were all kind of looking at Google. But this was after the whole .com stuff too, so we were all kind of skeptical of .coms and tech companies. So that it was a little bit of nerve wracking at that point. But here goes Google on this monster run, and I bought it. I actually bought some around here. I bought it improperly. So I don't know if I bought it around here, but I bought it around at this point because the one thing that I knew is like Google's gone on this big run and it hasn't formed the first stage base yet. It's like, oh, that must be pretty good, right? Because it has all these stages that it can go through. But it came down, and I'm embarrassed to say that I think I didn't get the exact low, 172.57. I think I sold at 172.67. It was just the most miserable thing, and especially on weekly charts, you see this Google chart that goes on forever, and you see this 172.57, and I know exactly that I sold 10 cents higher than that, and so I didn't get back into it at this time. I was like, oh no, it's going to come back in. I'm not going to get back into it. And this was all or none too, right? I didn't have to sell everything, but I sold everything at that point. And it only takes 1 second to sell. That's the amazing thing. You could have all these rules and stuff like that, but if you have a moment of weakness, it just takes 1 second to hit that button and sell. And now everything kind of changes. Now you don't want to be the idiot of buying it back and now getting whipped around and stuff like this. So it's crazy how you can change everything. But it comes back up here, and I remember when they reported earnings, they were like $30, and I was just thinking, oh gosh, it's breaking out, but it has a gap. I'm not going to buy gap because only people only idiots buy gaps at this time. I'll wait for it to come back and fill the gap, and I'll get it nicely, probably around 200 and stuff like that, you know. And I just watched in horror, just going up without me. And I just remember it was just like every day was just torture watching the stock just go up without me. So I completely blew this whole thing. But then I went back and looked. It's like, my God, this is an earnings reaction, and this thing didn't come close to getting filled. Look how well it kind of held here. And so that really imprinted in my brain on just that pain, just really just made a memory for me. So the next time it came around, I tried this one, where it's like, okay, they're reporting the earnings, and I tried this one, and this one ended up working really well. So this one, so now it gave me a little bit of success here, and so this is how I just kind of started noticing these more, where it's like, and they're and for stocks that I think had game-changing potential and all that kind of stuff. Eventually, what I realized is what's happening here is that these are newer companies. Wall Street doesn't understand them that well. No one really understands how fast they're growing, and so everyone's behind the story. So that's why you had these monster gaps, because they're blowing up their earnings numbers. They're guiding so much higher. And now all of Wall Street and all the funds are scrambling and fighting over each other and falling over each other to buy and buy these stocks. And so you can kind of see this just scramble. It just keeps going up, even here, just crawling up. So that's kind of how I learned it. So some other examples here. Here's Netflix in 2010. Coming out of this big gap. The reason why I'm bringing this up, and this is the beginning of its monster run, the streaming run, and you can see how huge this run is. The reason why I bring this example up is at one of the master's programs, one of the customers asked Bill O'Neill, isn't that straight off the bottom? It's like, hey, Bill, isn't this straight off the bottom, right? It's kind of like a half a cup. And none of us really it's kind of weird. And we were also in a correction too, right? You can see up here, here's the S&P 500. We're in a correction. Isn't this straight off the bottom? And Bill said, no. That's the most powerful breakout there is. And I remember like a number of us were looking at each other, like, really? So we were all just stunned, but looking back, you kind of put all the fundamental kind of pieces together. They're blowing out earnings. They're showing that Wall Street's way behind the streaming story. Look at the monster number coming in here, the 11 million shares. This was a number of big elephants just stomping on the stock at this point, right? So sea change of sentiment, character change. Something is up here when a stock is up 23% and 600% above average volume, right?
Yeah.
That's unusual. Boats don't have breaks, strength begets strength, right? And we saw with this where it just kept getting stronger and stronger. Now more funds are realizing that Netflix is onto something here. Facebook, same thing here. This one was up let's see, it's almost 30%, right? 30%, 749% above average, right? We were all buying this in house, all the Mark Smith team. We were all like, this is it, let's buy it. We didn't know. I didn't know anyone else was buying it. Only found it after the fact. But yeah, we were buying this. It was just a monster thing. They finally proved that mobile works for Facebook. As we know, this is the beginning of its monster run. Amazon. So this is one that was easy for me to buy. In this 2017, right? Strong prior uptrend, builds a base. They report earnings, just this up 13%, 400%. This one's a gimme. It's a large cap tech stock. I can easily buy this. I'll use the low a lot of times. Now you have to be careful that you don't get too far above the low, but I'll use a couple of percent below. I just don't want it to fill the gap. But these are those rare times where I will go on that first day and start buying. And this was the beginning of a pretty good run for Netflix. And notice Amazon. Amazon held the 10-day, came back, found support on the 21-day, and then, didn't even come close to the 50-day, right? So when you're in the right stocks in the right environment, they can stay above these 10 and 21 days for quite a while. So that's why I like to use them as guides. And that also tells me about the momentum. Is this kind of that sweet spot for our type of stocks? That those windows don't always open up. So if I start seeing some of these stocks, powerful earnings gap type of breakouts, that's telling me something about the market. Are these strong stocks staying above these 10 and 21-day moving averages? Are there a number of them staying above it? That's telling me something. That's just telling me that there's a lot of momentum. This is where you want to try to be aggressive if you get some good entries in some of these stocks. Apple. So Apple 2012 here broke out of the cup with a cup before. Then they reported earnings. Here's your gap up only 6%, 182%. I remember buying on this because it's Apple. You got earnings out of the way. There's a big stock. Went on an insane run back then. And this is like in 2012 wasn't not an easy year too. But one thing I was really excited about, I had heard a rumor that Bill was buying around here too. It's like monster breakout and maybe he's slowly scaling it around this time. So when you hear that those are kind of the concepts where you're looking for these monster type of breakouts and these game changing type of stocks. Notice it's able to stay above the 10-day. So these markets aren't always there. They don't always line up like that. But that's just one of the things. I haven't really bought too many earnings gaps lately in the last few years, simply because there haven't been that many. But that is one kind of tool that I'll use for what I think are some monster game-changing type of stocks. I think those are the examples. Oh, well, Roblox, I tried this one here. Very small on this day because it was up only 42% on that day. But I wanted to get a little bit. I knew that I was going to come back in. And then as it was coming in, then I was building more of the position. I sold into this. I clearly remember this one right here because I was Mark Minervini was doing his master trader program event. And so that was the live trading day. And so I hopped on for a little bit. And I remember I was watching Roblox gapped up that morning and then quickly filled in. And I was like, oh. And so I started to sell some of it and eventually got out around that time. But and then finally Trade Desk. Here was another recent example. I did not buy it. Usually I would buy it this day, but I was a little more hesitant. I ended up just buying out of kind of the traditional type of breakout on this one, but this was the earnings gap was kind of telling you that trade desk might have a chance after taking such a long time off. And this was one of the clues that maybe the market is not, maybe it's starting to tire up because it the fact that it was only going up 20% and not holding the 10-day longer, not holding the 21-day longer, right? This is another gauge on the market. These type of stocks should not come back this quickly if you're in a good market, right? So all this type of stuff, great stocks are going to behave a certain way in great markets. When the markets are changing, when things are changing, those great stocks with those growth potential, they're going to behave like this, right? Actually, this is not even that bad, but usually a trade desk or a stock with this type of profile after an earnings event like this should be able to trend up a little bit better.
Yeah,
So,
awesome.
questions on that one?
Yeah, I've got plenty of questions on this. So first, some names that come to mind are recent gaps. Tesla back in 2019 was awesome off the bottom there, kind of starting a stage 2 uptrend. Fastly back in 2020, I know a lot of people play that earnings gap. I think Twilio had a really nice one as well during that time frame. But I wanted to ask you, so when you've got a stock that potentially has a power earnings gap up like this, how are you looking to scale it into position on that first day, or even in the next few days, next few weeks, as it starts to kind of build out some structure that you can maybe add on to that initial position?
Yeah, I think a lot of times, like for an Apple and stuff like that, a lot of times it would be like kind of very similar kind of when it's coming up through the 50. I might have like a 5% position on the first day. That's general. Now it depends. Like if I'm having a good year, I have a lot of cushion, I may get more careless and more aggressive on that first day, right? If it's a stock that's right at the top of my list. But ideally, what I like to try is get a little bit on that first day, let it settle down, and start slowly buy over the next few days.
Mm-hmm.
Now this is not a lot of time, but here the problem is that if you wait too long, if you're in one of these really strong markets, they'll just take off without you, right? But so kind of the ideal kind of thing is you have the earnings gap, it settles down, maybe creates like a smaller VCP type of setup and that's why I like learning Mark's stuff too, where it has those characteristics, starts tightening up, and then as it emerges out of it, you buy out of that. And I think I have like I have an example of Snap a little bit later, but which is a little bit different. But I used the VCP after an earnings gap to get into that one. So that's the ideal kind of thing. But if it's one of these stocks that are on my radar that I really know the story, stuff like that, I'm not going to wait around too long. So I know Scott St. Clair, he has an interesting approach where if and I think let's see, the Roblox is a good example of it, right? So he won't necessarily buy on the first day. If it comes down and undercuts and it comes back through, so on this third day he'll buy. So so if it undercuts, so I'll buy a little bit on this first day, and I knew this was going to come in. But sometimes they don't, right? So I'll buy on the first day. If it takes off without me, I'll still keep that. Say the next couple of days were like these 2 days, right after this earnings gap day, I'll still have my small position at that point. I'm not going to really buy anything more. But if it comes back in, undercuts, comes back through, and when it undercut, I'll probably lighten up a little bit just to respect my kind of exit strategies on this. But when it came through on that the third day, I started buying it back, whatever I sold on that first day or second day. And then, so this one I'll buy, and now you're also using that the resistance area right here too. You can buy a little bit here. But these are consolidations, are really big. So when it's kind of a consolidation, I'm a little bit more hesitant to buy at the all-time highs right here. But when you have that little shakeout, undercut, getting into the gap, and now it's coming back through, I like that. So I do steal that from Scott. And then, yeah, as it comes back in, this is such an extreme bar, but you can also use the top of the earnings gap day as another way just to sprinkle on a little bit more if you wanted to. This one, I wouldn't apply it because it's such a wide range on it. But So it isn't. Yeah, this is where
It's
you're
the
just kind
art.
of
Yeah.
scaling in. Yeah, it's. I wish it was more. Now, and Chris Kessel at IBD, he has an they'll use Justin and Chris and those guys. What they'll do is they'll watch like the 5 minute bar on that earnings gap day, and if it takes out that first 5 minute bar, that's when they'll start buying. So sometimes that first 5 minute bar is sticking up there, and then they really sell. It really sells off. And so a lot of times I might buy a little bit on that first one, and then I'll have to get stopped out. But they'll use that first 5 minute bar on an intraday, and then if it takes out the high at that first 5 minute bar, then they'll start buying. So that's another strategy that I'll sometimes watch, but a lot of times, and that I think you asked this question a while back. I mainly use dailies and weeklies and monthlies. I
Hmm.
don't use intradays too much. I've found for me, intradays they just make me trade more and make me more anxious. I think the weeklies are the best thing you can use, but I have a tendency to go more towards dailies at times. But weeklies, I think, are the best compromise of everything, where you get the longer term kind of view or decent intermediate term time of view, and it removes a bunch of the noise that you can kind of see what's really going on with the stock.
Perfect.
Did that answer your question?
Yeah. That
Okay.
answered it for sure.
Um, what did? Okay, so I wanted to show. Oh yeah, let me see if I can find that snap example
Sure.
here. Right. So this is an earnings gap right here. Um, so when it was just kind of coming back into the 21 day. So in this case, I didn't buy the earnings gap on this. I let it run up. When it came back in and kind of settled down here and started to merge out, and it's not really kind of VCP, but it kind of settled down and gave me a little bit of a short term kind of resistance. So I use this, and in this case it kind of works. So it was really these kind of days when it came back in down, found support on the 21 day. I kind of used the top of this to buy a little bit, and then bought a little bit more here. And then it took off. And then I for this one, since I knew I was just playing more with fire,
Hmm.
uh, I just took the gains at this point. It turned out to be a decent gain, but so I was like, you know what? Let me just take the gains. I got away with one, right? Because this is you're really kind of parsing it very fine. It hasn't really gone sideways, really set up anything. So you're really parsing it fine. So I just took the gift at this point on this one. Okay, so well, first, I mean, here's one thing, and force, no forced trades, and I know Mark Minervini talks about this a lot, and I'm guilty of this, like a lot of other people. But here's Trade Desk. This was back, so this is in 2021, but I didn't really participate in Trade Desk run here. I was focused on other stocks, and it was so choppy, but it went up on this monster run. I think Jim Roppel did really well in this one. But so I wanted to get into it because everyone else is getting into it, and I was feeling left out. So it undercut. This one was really sloppy base. This is not really kind of what you're looking for when it's coming up through the 50. I mean, you're first of all, it's gone on this monster run, right? So 300 up to 900. Now, that's not normal, right? Now it's coming in, selling off monster volume coming in. And you're setting up. You had a little bit of shakeout here, so that's a little bit of a positive. But it's just kind of all over the place. But it's coming up, and I was like, I don't care. I'm going to buy it. It's probably I don't want to be left behind. So this was just unnecessary. Now it worked a little bit, and then this might have been earnings or something. I bought more, and then I got caught in this gap down right here, which is kind of out of the blue right here. But it was a good lesson where this was really sloppy. It's not precise, and I got what I deserved. Right? And this was just one of those indications that we're not in 2020 anymore. You're not gonna, you'll get away. I mean, this is pretty sloppy. A lot of these type of things, this action, this whole way up in 2020, but you're not going to get away with stuff like that. In most markets, you're not going to get away with stuff. 2020 will forgave a lot of flaws and stuff like that, but here is just an example of I got my head handed to me, and it was a good lesson. And the markets are always teaching you lessons, and so I'm not even sure how far this one. We can pull it up in Market Smith. Let me
Yeah,
see here.
I think it consolidated for a few months and then had that earnings move, which I think you showed earlier. So yeah,
Oh,
from
so
this point on, it really took a hit all the way back to its 200-day, I believe.
okay. Let's see. Let's see if you're right, Richard.
Oh, undercut that 200-day. Yeah.
Oh yeah. See. Yeah. See. I mean, yeah. I think I sold out around here. That was in February.
Yep.
Yeah. So it went much lower, right? So this is a rule. I mean, this is why you cut your losses, right? Uh, that even though I mean that's a good 20+%, and there's no, well, at least for me, there's no way I'm gonna hold through this whole thing, right? If I bought, this is where I bought, right? This is right up here. This is where I bought, um, right here. That's where I bought. This is where I got hit. This is where I sold, and this is where it went down too. So that was right around like 78, went down under 50. I mean that's almost a 50% hit right there. So I'm not gonna ride that down. So the way I learned, but remember that Skechers example where I got hit 70% on those stocks. Just get out of them, right? Roblox. You want another example of
Yep.
right? So I cut. Well, I sold out Roblox around here, right? If you don't sell out here and you get caught around here, you have to sell here on this week where this is your 10-week line. You have to sell here. I mean, the problem is, and I would have never imagined Roblox to go down this much. But it doesn't matter. Stocks are only good when they go up. They can go down a ton. Here's Shopify, right? Shopify, I bought, yeah, I mean, I am the master of buying right at the top, right? So I know that I better cut my losses. So I cut my losses here. Shopify's 65. How can Shopify be 65% off its 52-week highs, Richard? I mean, that's impossible, right? But that's the thing. The markets they're going to do what they're going to do. Obviously, their valuation it was way off, and the markets are going to punish these stocks. So these stocks can go down a lot further. I mean, Upstart, right?
Yep.
Upstart, I was in it here when it broke. There's a gap down on earnings. I sold out here. Now it's only 77% off its high. I felt like an idiot when I was down, selling at and that was like probably like a 20% loss for me. You're going to sometimes get caught in some earnings gaps down. I didn't have a big position, luckily, but when I'm caught in those earnings gap down, I'm out. Right. So yeah, and it goes all the way back. That Skechers example in 2001 where I just blew up my account over. I mean, but I was playing really small, and I learned how hard it was to recover from those losses. So when I'm down 8%, I don't play around. That's the one thing I do really well is I cut my losses. I'm always messing up on the upside. I'm in a lot of the right stocks. I always mess them up on the upside, but I do not get caught to the downside. And that's the difference, and that's what's enabled me to be around for 20 plus years,
Right.
enabled me to survive because I am not that smart in this. I do so many stupid things here, but the reason why I've been able to stay around and grow my portfolio slowly over time is because I have avoided these type of events. These portfolio destroying type of events will knock you out of the game. And that's the one thing that I've been able to do is I've hung around long enough to participate in great markets. Because when they're great, like a 2020 or some of these other decent years, you don't have to be smart. You have to be great at this. You just have to have money in the markets and everything will go up. And then you just try to hold on to that money when everything goes down.
Yeah, it goes back to the first thing you talked about, playing defense, and that's what keeps you in the game. So yeah, that's a great message to put up. And if you could bring up Fastly, this was my
Oh
biggest
yeah.
loser in 2020. I'll talk about my earnings gap down, and I sold that day. I mean, it was down big. Let me go
This one
ahead.
here?
No, this one right here, actually.
Oh, okay.
And I mean, from this point on, I mean, it's been a dog of a stock. So we talked about character changes to the upside with the earnings gaps, but gap downs are kind of the opposite. They can start longer term downtrends. And this one, I don't know how much it's down 75% off its all time high. So yeah, you got to pay attention when price and volume talk. You better listen and respect it.
Well, yeah, I got caught in this gap down for Fastly and this. So yeah, then I was like, okay, I'm not I'm not playing with this stock anymore. Yeah, it was brutal, and I was very optimistic about this company. I actually, and this is an earnings gap right here.
Yep.
I mean, it started out with an earnings gap. I knew about the story about that time. I started learning about it, luckily right before, and I bought it. I started buying after that earnings gap, and then all of a sudden, I'm a genius here, and and then I just got my head handed to me. But I just know, hey, when the market's saying get out, this is where the market's not slowly pushing you out at that time. It is shoving you out of the way, and don't come back. It's shoving you. Don't come back. So don't come back, right? So yeah, well done right here. You said it well. It's like these earnings gaps work to the upside and the downside, and it goes back to that sea change of sentiment, right? Strength begets strength, weakness begets weakness, and in your case right here, yeah, weakness begets weakness. So 80 is a pretty good sell right now. You probably felt pretty bad at that point, but 80 is a pretty good sell when it's down at 18 now. Absolutely. And fundamentals you're not gonna figure out that it's gonna go down. The smartest people are not gonna figure out it's gonna go down to $18. I don't care what anyone says at that point. These markets will always befuddle the smartest people. The analysts are, rightfully so. I don't blame the analysts on these things, but it's impossible to, in my opinion, it's impossible to kind of figure out how far these stocks can go up and go down, because you're really trying to figure out the irrationality of humans and emotions and stuff like that. And people they'll take these to the extremes both ways.
Absolutely. And I think it was actually this earnings gap down, this one that you also got hit at. I think that's what I was actually talking about. I think I maybe tried it up the right-hand side here, got shaken out, but this was the bigger hit that I took in 2020. But yeah, regardless, I mean, definitely a lesson learned about that. So perfect, Irusha. Is there anything when it comes to charting that you think you'd love to cover today before we move on?
No, I can't remember anything right here. Let me go back to the
the
PowerPoint. That would probably remind me, because I have a very bad memory these days. Oh, expectation breakers. See?
Yeah.
That's why I write all this stuff down, Richard, because I don't remember anything. So this is something I learned in-house, expectation breakers. I think it's from Mike Webster. I learned this, but so, and this is one that I'm still working at. But here's Devon Energy. I bought Devon at this point, and there are some stocks, and I'm trying to get better at this, but you also, at least for me, I have to be realistic, so I don't beat myself up too much on it. But there are some stocks, there are some types of stocks, there's some industries, things like that either you're not going to be able to understand, or you're not going to trade well. They're just going to trade differently. So it goes back to, I'm used to trading those larger cap tech stocks. They all kind of have the same kind of feel the same kind of feel. They behave in a similar way when everything lines up. And those are that's where my trading history has told me that I do better at. If I try to apply those same kind of things to like a commodity stock and things like that, I kind of get thrown off, because these are more kind of pullback a lot of times. But I tried Devon. It was on the chart. It looks great here. Coming out of kind of this cup with handle. Could have waited for the 30.55, because that's a clear resistance, but I was using more of a descending trend line right there and saying, okay, let's get into it. I don't have a lot of exposure to energy stocks, and Devon, I screwed this one up here, and I was waiting for it to come back in. So tried it here, and and this, I think, with the market was just starting to act bad, poorly and stuff like that. So I cut pretty quickly here. And so I got out of it. I was just starting to try to scale into it. I backed out pretty quickly. Now it gaps down. Now I'm like, oh, I'm a genius, but I missed something really key here. First, you could use this as like, you know what? There's an opportunity to buy off the 50-day where your risk is very defined. Yes, now it is a gap down right here, and so you are taking a little bit of you are taking more because it came down pretty big volume. So you're taking more of a risk here, but it is coming to a pretty key support, not only where it's held recently, but then you also have all this support right here that was previous resistance. So you could use that, and then the next day it held up above it too. It's not exactly an inside bar, but it's kind of similar to it. When it comes up here, now that expectation is broken, right? So if I go back, I'll go back here. When it gaps down this big, the expectations are this thing might be done, kind of like the FSLY example and stuff like that, right? It should go lower. That's why you sell a lot of times, right? It should go down. When it comes back up, that expectation now is broken, right? And so here, this is where you should buy back if you really like the stock, because in reality, it didn't do anything. It didn't really do anything here. It didn't give a sell signal. It didn't. It kind of broke through that resistance now, and so it's still fine here. So looking back, I should have bought it back. Even on that day, I was like, I know I should buy it back, but I'm not going to, because I just don't do well on these things. But I missed out on a tremendous opportunity. Now it came back again, right? Oh no, actually, so yeah, here it's and then the next day it broke out. Now that was a clear breakout. Now for tech stocks, I don't care. I'll go into it. Here I kind of got into that point where now I'm going to be the sucker buying out of the breakout out of this commodity stocks. Breakouts and commodity stocks won't work, and so I completely blew the whole trade. I picked the right stock. You're not always going to get the timing right. But I was not flexible enough and open enough to realize that all this was a little bit one last shakeout, and it was coming back, and I didn't react to it, even though I didn't really even get hurt. I didn't really sell at much of a loss, but I didn't realize that take a shot here. So this was a huge missed opportunity for me, 20+%, maybe more. But these things add up, right? These will add up over the years if you miss out on these opportunities. Novacure. So I tried this one right here. Now this one, it was pretty sloppy right here, but the volume pretty low, coming up through a resistance, a little bit of descending trend line. This was a monster move right here. They're doing, obviously a lot of the medical stocks are doing really, really well. So I bought a little bit of position. I'm not going to be as aggressive when they're sloppier like this. And then, it shakes me out. I sell out here. And so why am I selling out here? Because I think this is going lower. But, it undercuts, and now it comes back up through the 50. It's not going lower. So this is what I'm trying to, these are things that I'm trying to just tell myself over and over again, that initial reason why I sold, that is false now, right? It's not necessarily done. It's not going down. That's why you're selling and using these kind of things. So I'm trying to figure out ways I should adjust here. I'm trying to, put these rules up for me. It's like, okay, I should adjust here. You could use little bit of within the little short-term resistance to get in. If you really like these stocks, right? If you don't like the stock, then let it go. But if you have the conviction, you're getting shaken out, and now they're breaking those expectations that they're going to go down. That's why you're getting out. Or obviously, if you're managing your risk and you want to keep those losses small, that's a different story. But there needs to be some other rules to help you adjust, because these stocks aren't going to go straight up, straight down. They're doing this kind of chopping higher, chopping lower kind of stuff, and always giving you reasons to get out of them. So here you have this opportunity right here. Then you had 2 more days, right? And then you had a very powerful, you had a clear kind of breakout. This is really essentially kind of an ugly coupled handle, but a very strong breakout. You have the blue dot, RS lines going in new high while breaking out through resistance. There's an opportunity. I didn't buy it there. And here's another missed opportunity, right? So you got to catch yourself on stuff that if it's not going along with that kind of expectation you had, that it was going to go lower, it's going to break support, and now it's not doing that, have some kind of rules to catch yourself, because you might be getting one of the people getting shaken out. Right. And you're going to get shaken out. Getting shaken out is part of the game, but getting back in is also part of the game. That's the difference. So this is another missed opportunity that I had. I picked the right, picked a good stock, didn't capitalize on it. Here's another steel producer commodity stocks. These were just driving me nuts. But here I tried this breakout, right? Because I'm just trained to kind of buy these breakouts. I don't want to let it go away. It comes back in, I sell it. It goes on without me, right? And I just couldn't believe that it went on like that again, because it was just kind of all over the place. But another missed opportunity right there. So it's just compounding. And then Valet, which was beautiful couple, strong power uptrend, beautiful couple with handle, breaks out. I'm buying it here. Where are we? Oops, I went the wrong stuff. So buying it here, comes back in, tries again. Now this one right here, and I didn't get caught in this one, but what the mistake I made here was I took it on my radar, right? Because the reality is that it's still building a trading range. Yes, it's not the nice, neat cup with handle, but it was building a trading range. It had a little bit of an undercut, right? Undercut that 612 level and then comes right back up again. So there's a little bit of shakeout you could have used. And then finally had the powerful breakout again, taking on everything.
Yeah.
And if you missed that, now it's coming back, consolidating a little bit right around the top of that base. So I just kind of took it off the radar because it hurt me. And I let my previous trading experiences with the stock get me at this time, but another missed opportunity. So all these kind of things, these are all tremendous missed opportunities that I had, that I was right on the stocks. I didn't capitalize on them because I just let my previous experiences and not having enough rules on the expectation breakers get me back in and say, try it again. And I was probably wasting my time on some tech stocks that were going down at that time. So I think, those are expectation breakers. I don't know. Good questions on those, Richard?
Yeah, those are something that Mike Webster, he kind of got those on my radar, that phrase expectation breaker. Any kind of lessons that you learned from Mike about how to deal with them, how to stay on top of them, how to, just use them to effectively trade?
Yeah, it was kind of, you don't want to complete, if you get shaken out of them, you don't want to take it off your radar. Right. Put it on another list, put it somewhere on a quote board and check it every few days just to see if it sets up again. Because you very well could be right on the stock. You're just wrong on the timing. And it just might be short-term timing. So that's kind of the big thing is it's amazing at how often you'll sell out of a stock, you get shaken out of stock, and they just go up without you, right? That's and that is part of the game. Everyone's going to get shaken out, right? So the more you can kind of do, that's just an opportunity. The way I look at it, it's an opportunity to improve. And so once you get past the big kind of rule breaks, cutting your losses, using relative strength, buying, having a system to manage your risk, all that kind of stuff, and entries and all that. Once you get those kind of things down, we can all get those down very quickly. But where you can get better and better and how you improve is little things like this, and these are tough. This is that post analysis that you go through. It's you have to go back, and I didn't like taking snapshots of these and putting them up and showing it for everybody. But it's tough to look at this. But as you can see, these are things that I'm doing over and over again. So I have to figure out a rule to get back into it. So one of the rules, don't take it off the radar, put it on another list. Maybe these are recent stocks that I sold. You can look at that every few days. On the weekends, you can look at it, right? So stuff like that. A lot of times you can set alerts. If you get stopped out of it, or it breaks, and maybe you're selling too quickly, maybe you can set an alert a little bit above it and say, hey, let me know that if it's coming back again. I want to take a look at it. I like the story, all that kind of stuff. So those are a few things, but the big thing is you don't necessarily have to give up on it if it doesn't do something like that FSLY Gap Down, where not that you can wipe it off. Chances are it's going to go up, but even then you could put like a little alert above the gap and say, hey, if it ever starts going back above, let me know. You may get an alert 6 months from now. But so those are kind of those are kind of the key things that I learned from him, and others is, you don't necessarily always take it off. You're not going to sell these stocks perfectly to the upside or downside, and there could be a lot more room for these stocks to run. It just might be going through a normal kind of shakeout.
Yeah, I think you touched on something that's really important there. Post analysis is tough, especially when you're looking at messed up trades. But if in 2030 you remember what happened with NVCR, and now you got shaken out, and another stock kind of sets up that same pattern, and you end up making 100% or 50% on a trade, I mean, that post analysis more than paid for itself. So that's the goal. I mean, it's just to improve a little bit on your weaknesses and mistakes, and just try to be a little bit better the next time. I think that's really important.
Yeah, yeah, they're all subtle little improvements, but that requires just going back and looking at all your mistakes, and that's
Yeah,
the worst, right? It's
yeah,
not fun, but coming up with these little things, come up with these little rules. That's how you're just gonna get better.
absolutely. Cool.
Let's see. I'm not sure if there's. I think we covered most of it. Oh well, I mean, this is just it's another dumb thing that I did, but like C limited, right? I was in this, but I didn't have a big position. I was up like 100% on it, and all I was doing is like, just give me a chance for it to come back into the
Yeah,
50-day, and I'll buy more. I can build more of a position here, and it comes back in here, and I don't buy it, and it goes up another 100%, right? So when you have these kind of rules and your plan, follow your plan. Buy a little bit of it, but do something so at least you're following that plan. So that was one of those kind of lessons, that because you're always going to kind of break these rules. So write down those kind of rules, those plans, so it reminds you. And so that's one thing.
hmm,
Taking the gains. I mentioned this earlier on. Taking profits, things like that. Here's Generac. I bought this in 2021, getting through this kind of resistance area right here. Pretty good volume. It's like, let's take a shot. I didn't know how well it's going to work. It ended up working pretty well. I just sold out here. At this point, this is like probably 20% gain. I just
hmm.
locked it in. It wasn't one of those top stocks that game changers, that even though it did go on this monster run. But it had gone on a monster run. I was like, how much more could it go? Let me just there should always be some stocks that you're locking in the gains to try to make up for to try to build up a cushion enough that you can hold on to your top three stocks or whatever that are going to pull back. And so that'll enable you to ride through some bases or ride through some pullbacks if you take some gains on some of these other stocks that you might not have as much conviction in. So here it was just a percentage thing. Didn't break the 10-day or anything like that. Just a percentage, locked in those gains. It did go up higher without me, right? But you know what? I still just got those gains on that one. So that's always been the hardest thing. So just locking the gains, locking the gains. That's another thing that I think Mark Minervini has been a very good influence on me, because he'll show just kind of the effects of the compound and stuff like that. And so his books talk about that. But
Hmm.
Tesla, getting a little bit more. So I'm so kind of trained. My eyes are so trained at kind of classic up with handles, things like that. Here's Tesla in 2021. Uh, just I don't know what it was building here, right? It was just obviously went on this monster run right here. Then it's going through this whole big base building process, but it goes through all this kind of volatility. Then it just kind of settles down, right? And it starts doing this stair stepping, and I was getting shaken out of these things here, and so one mistake is I wasn't patient enough here. I think I bought here and I got shaken out here, and I was playing really small, but I was too quick on the trigger and not really kind of just taking a step back and looking at perspective and saying, you know what, it's coming back. This was normal action right here. When it's kind of coming back, it's going to slowly test an uptrending 200-day moving average coming into previous support. There was no
Hmm.
real reason, unless you're down, that your percentage, then follow those rules. But if you're not down, when you're looking at it, kind of the price and volume action, completely normal action right here. But I ended up, set up again here. I think I bought a little bit maybe here too, but set up here. So, okay. So now it's breaking out this little consolidation. There's a little bit more of a kind of resistance around here. let me slowly build into this, even though I don't know what this is, right? Because it was just kind of messing with my eyes. But it was Tesla. This gets back to one of those, okay, I know this stock can run, one of my top stocks. I'm going to take a little bit more risk at. I wouldn't necessarily do it for like Generac, like we were looking at before, but for a stock like this, I might take a chance. So, and then this one worked pretty well. Now, mistake here is I should have sold some, but I didn't until around here. Because it was up. I was like, it just broke out of this base, even though I knew this was just this weird base after its monster run. My bias with Tesla and knowing how far it can run, how well it's done over the years. I probably gave too much back out of it. But so that's another thing. I think those were kind of the big kind of rules, and of course conviction. I mean, that's we've gone over that. But and then I guess one final one here, Corsair, right? So this is sometimes going back to the well. Here's Corsair, came out of the IPO. I just remember Corsair looking at Best Buy, seeing those keyboards and and I just remember they're like $100 or whatever. I couldn't believe it, but I mean that's a huge, esports is a huge business, right? So it was coming out here. I think I was talking about this on IBD Live. I tried it here. It goes up this monster amount. I'm a genius at this point. I love this stock. It had monster earnings and sales too, so it made sense. So maybe it's the next big winner right here. So, I did end up locking in the gains, but once it started signing up again, I was like very quick to get back into it. So I was trying it here, but what is this really? But it's all over the place still, right? So, but I was trying it. So I was just getting whipped around. Here, I tried it on this day. Took a quick loss. I think I took like a 10% loss in 5 minutes on this one. It was just all over the place, right? So this is kind of the fear of missing out, when getting yourself too emotional, going back to the well when it's not, the stocks aren't really ready, going back because you did well in the past, just going back over and over again. It's like, oh no, it's going to be the next great winner, when you're not looking at it factually and objectively. This is just all over the place. It hasn't set up too much volatility. And so this is just a unnecessary loss for me. So that's another lesson that you just have to be careful of. These stocks, just be patient, be disciplined. If the stock is truly great again, it will give you another chance to get into it again. So essentially, yeah, the kind of the things that I want to kind of leave everyone with, especially those who are newer, right? Learn those basic rules first. I mean, that's a big thing, but eventually you want to adapt it to your personality. So initially it's going to be black and white, then take that, adapt it to your personality. Now, one thing I realized early on, buy and hold wasn't for me. It's for plenty of people, and that's fine. Doesn't necessarily mean it doesn't work, but it didn't work for me. Pulse analysis. You saw this is a lot of this is my pulse analysis right here. Learn from your mistakes. It sucks. Yeah, it is not fun to go back and look at all the dumb things you've done in real time, but that's how you get better. And so it really is a never-ending process on this. Cut your losses, play defense. The Skechers example was a very good, and that was only one. I think I had like 4 or 5 of those. But finally I realized, that's why Bill has that 8% rule, because it's really hard to recover when you're down 70%. So that's the first one. You have to get that out of the way. You have to get that one down, or you're not going to survive. You're not going to be in the game. The ones who end up doing well are the ones who hang around the longest. I've seen this when working at MarketSmith, talking to people for years and years who were around. They just hung around long enough. They survive, and then boom, they find themselves in a 2020 or another decent rally. So then key lessons from the portfolio managers in-house that I've learned: see changes sentiment, right? From Scott O'Neill, learn that just when there's a character change, that strength can truly beget strength, or as we saw with the fast example that Richard brought up, weakness can beget weakness. Expectation breakers. These stocks aren't going to go straight up or straight down. Have some rules to kind of adjust to the volatility or the shakeouts. You're going to get shaken out. That's part of the game. Pullback buys. That's another thing that I continue to work on. You're always trying to add different kinds of entries, different kinds of ways, or different kinds of rules. Maybe just a rule that you won't sell until it truly breaks the 50-day. It's up to you, but you always want to try to improve and try to figure out ways and rules to help you keep yourselves in the best stocks throughout the life cycle of that stock. And then I think there was one. Is that it? Oh yeah, here we go. Yeah. Then so yeah, in the beginning you want to get the basics down: fundamentals, patterns, risk management. 2020 was an unusual year. Okay. When I got started out, it was 99. I did not realize that was an unusual year, but it took me 20 years to see another one like 99. And finally, this is a long-term game. Okay. We're not always about long-term investing, holding through everything thick or thin, a particular stock, but the stock market's going to be around a lot longer than we're going to be. And so you want to hang around, survive long enough, because you can then finally participate in those great markets. And no matter how bad these markets are right now, and there's going to come a point where they are going to change, and they're going to change when everyone gives up on them. So, but you don't want to. So just survive, and then you'll be able to thrive when those markets are truly ready to go back up.
Perfect. Irusha, thank you so much. I really enjoyed going through the charts there, and I think there's some really amazing lessons there, especially for newer traders watching. Take notes. And with that, I always like to end it off with one last question. You talked about a lot of lessons and guidance for new traders, but just in general, is there kind of some general advice, I guess, for traders who want to become better and just improve, learn new strategies, and just get more performance at the end of the day?
Well, I think the first key is don't give up. There are so many times where I wanted to give up, where I just like, what am I doing? So don't give up. I think one thing is a lot of times one reason why I didn't give up is because I kept another job, so it reduced the pressure of having to do well in the markets all the time. So that's a big thing. And if you can, I think that the key thing is if you manage your risk, you're always going to last and survive in the market. Even the smartest people, they get themselves in so much trouble because they have a fundamental conviction, but the bear market or some correction takes those stocks down so much further, and sometimes they don't come back. There are plenty of times where they might come back, but sometimes they don't come back, and all of a sudden you're stuck with this monster loss. Like Fastly, I've heard from a number of really smart people of how that was such a game changer. The edge computing, the guy who essentially created that was the founder of Fastly. All this incredible stuff, and guess what? It's down 75%, and Cloudflare took a lot of that business away from them, right? So, or Roku's another one, right? Roku's doing amazing things. I had a position in that in 2020, and I had so much conviction, and I cut my losses once it stopped working, and once it's had a character change. I watched people who are much smarter than me just ride it down, and now they're saying, oh, yeah, I guess Google and Apple just came in and just took too much of their market share, right? It's hard to realize that in real time. So the only kind of chance we have, I think, with the markets and to avoid these kind of portfolio destroying losses are having the exit strategies, having some stop losses, learning how to read charts. I would still be holding on off Fastly or Roku right now, because those stories are so good. So those are kind of the big things. And in the end, the market's always right. And so just learn to listen to the market.
Yeah, absolutely. And Ross Haber, he always reminds me, we can buy on both fundamentals and technicals, but we sell only on technicals. And that's
Absolutely.
for a reason. We got to follow those sub rules. So Irusha, thank you so much again for spending the time and sharing your strategy, some examples, some post analysis with us. And where can people reach out to you if they want to learn more about your system? Is Twitter a good way? I'll have some links down below in the description.
Yeah, Twitter's fine. I don't always check it, but yeah, honestly, the best thing to do is if you want to learn this and stuff like that, investors.com. I'm no longer part of the company. I still help them out, and so I still try to be as much as possible. But investors.com, MarketSmith, obviously, I was part of that group for many years. Those are the best places to learn, and obviously, a lot of my friends and colleagues are still there. So those are the guys to really go for.
Perfect. So we'll leave it there. Thanks so much for watching, everybody. I hope you enjoyed. If you did, please go ahead and leave a like down below and subscribe if you're new to the channel. And we'll see you guys in future videos. Thanks.